Good morning from our global headquarters in New York. I'm Manus Trenny. Welcome to Bloomberg Brief. Let's set your agenda. Countdown to the US CPI. Will a cooling and the core embolden the risk-on rally? Washington's trade battle with Beijing intensifies. President Biden is set to quadruple some tariffs on Chinese goods this week. And choosing France, Microsoft, Amazon and others unveil major investments. The French President Emmanuel Macron will join Bloomberg TV for an exclusive interview later today. We're counting down to that conversation between John Micklethwait and Macron later today. More on that. Week 4 of a risk rally. We're going to grapple with a lot. The CPI, will the core cool sufficiently to reinvigorate and really hunker down on those rate cuts? The consumer sentiment is at a 6-month low. You've got Cisco, Walmart and Home Depot all coming through. So you're going to hear more about the consumer. Bottom of your screen is Alphabet. Now, Apple, we understand, may well announce a deal with OpenAI for ChatGPT. Who's the loser? Right now, the market thinks that Alphabet is the loser. Apple is bid by 0.8%. I said we're counting down to the CPI, and indeed 10-year bonds are flat at the moment, but the stakes are high. The last time we had CPI in April, it really spooked the market, up by 18 basis points. We're expecting a moderation for the first time in 6 months, 0.3% on the core. Now, when you throw a load of money at a market and you try to intervene and you stop the rot on dollar yen at the bottom of your screen, 155.87, that doesn't exactly work. So you trim back the amount of bonds that you're buying in the market. And this is a message to the market about trying to raise those rates. We're up, we've given a few ticks back at the moment, but we are shy of that 0.97, which was the November high. This is attempting to close the yield gap. Some people will say it is perhaps a little bit of a feeble attempt. We can debate that through the morning. So it is week 4 of the rally, as I've said to you, and investors are bracing for this CPI number report tomorrow, which could be a major test for the markets. There you go. There is your S&P 500. My guest this morning is Senior Multi-Asset Strategist over at State Street, Marija Veitmane. Marija, good to see you. Week 4 of this rally. Consumer confidence is on its knees. Well, not on its knees. It's on a 6-month low. You got wages under pressure. We're spending less at Starbucks. Are you nervous? Are you anxious? Are you all in on this rally?
Good morning, Manus. Good morning, everyone. I think that this rally, as a lot of things in U.S. economy, is kind of 2 tiers. So we have some companies that still able to generate strong profits. They often, larger cap companies, they often have very, very strong balance sheets. They tend to serve maybe slightly more affluent consumer. Those companies doing well. That part of the economy is doing well. There is another part of the economy, the companies with tighter margins, smaller companies selling to kind of lower and maybe even middle-class consumer that beginning to struggle and showing cracks, like you're mentioning, like Starbucks and McDonald's of this world. So I think it's very much depends where you're looking. I mean, fortunately, large cap companies, mega caps doing great, so that's supporting index overall, but details are less encouraging.
Do you think we're running into some kind of an exhaustive point? And I ask you that question. I mean, we've had this rally in bonds, we've had a rally in equities, but I was looking at what Academy have written over the weekend, and this is what Peter Cheer writes. I think we are near the end of a lower yield Fed put rally that has helped stocks creep higher on anemic volumes. And this goes to the concept, Marija, of exceptionalism and what that exceptionalism is. Do you think there is some sense of exhaustion in the equity market?
Again, as I said, part of the equity markets are really struggling, and part of the equity markets have been supported by a kind of rate environment, and that rate environment is, I mean, I think we are more in the camp of higher for longer. So we're not kind of expecting immediate help from the Fed. I mean, thankfully, I mean, Chairman Powell kind of ruled out hikes, so that's great. But again, like what's next? And cuts are maybe not imminent, and when earnings are not doing as amazingly as lots of people hoped, that's a problem. And as I said, I mean, my favorite stat from earnings season so far was, okay, overall earnings are growing and ahead of expectations, but all of this growth comes from mega cap tech, while S&P X Tech is actually seeing earnings contraction, and for, I think, fifth consecutive quarter. So that's not a great support. If you don't think that rates are cut immediately by a lot, I mean, that's not fantastic. So that part of the market I'm really, really worried about.
But yet your mantra has been to have a barbell approach, to quote you from the last time you were with Danny and I, which was on the two tails. You wanted cash and you wanted tech. So I take it then you're being even more segregationist about the tech. In other words, you are even more entrenched in big tech. And if I look at big tech, you look at the dividends as well. Meta, 50 cents, Alphabet, 20 cents. So does that reinforce, does the dividend additional hook reinforce the barbell scenario for big tech for you?
Yeah, absolutely. And I mean, the reason tech is so willing and able to pay dividends is because their balance sheets are like fortresses. They're fantastically strong, and free cash generation is amazing. And that's not many companies in S&P that, or anywhere, that can really afford that and can make that. I mean, often dividends is kind of your signaling idea, right? So that I'm very strong. And I mean, tech is really, really signaling that they're very strong. They're not really suffering under higher interest rates. And yes, consumer is slowing and we're seeing cracks here and there, but not in tech.
No, definitely not. Give me your sense. I was rereading what Andrew Bailey had to say to the market, and I think it's very interesting. It's almost as if we're stepping into the unknown. So we're going to go into this world of where we're cutting rates perhaps without a cataclysmic event, either in the UK or in the US or in global banking. Historically slow cutting cycle. This is not 1998. This is not 2001. This is not 2008. Therefore, what I would ask you is, we're stepping into the unknown. We don't quite know what this cycle is going to look like. But if it is historically slow, how much more defensive do you want to become? I know where the barbell is for you, but is that the kind of slow minutia of cuts that you're expecting?
I mean, there are two kind of ways to answer this question. I mean, first of all, if if central banks really take it very slow, I think there is a risk that we kind of create more and more problems, because, as I was saying, is that there are some parts of the economy that desperately need cuts and other parts that are doing better. So on average, it's okay, we're going slow, which is not fantastic for the first part. But secondly, what I'm really interested in terms of equity market, so how defensive you want to be. So if you look at margins, and I think margins are really important right now, the thinnest margins, so the biggest decline in margins are in consumer staples and healthcare. So ultimately, your defensive sectors, but they're really, really struggling right now. Or this kind of margin pressure is really hitting them because they find it very difficult to pass higher prices to consumer. And I think that's really important. So that you can't really go to your normal defensives in terms of equity allocation, because there is like a margin problem. So your defense in current market environment is really large caps versus small caps, as opposed to kind of sector tilts. And I hate to say, but all roads lead to tech again.
Marija, it's going to be when the dam cracks and you come on this TV and you say it's time to step out of cash and perhaps trim my tech allocation. You know, that's a red headline in itself. Let's just talk about some of the challenges in that broader market. You talk about the profitability in the broader market being challenged sequentially for a number of quarters. If Danny was here, I know she would be Judy Brown to ask you this. We're looking at the debt compilation in the Russell 2000. $832 billion worth of debt. 75% of that matures by 2029. Maybe this is the more factual reason why this equity market, the broader equity market, so desperately needs rate cuts, even if they are insurance rate cuts.
Yeah, absolutely. 100% agree with you. And I think this idea that equity markets were able to rally, say, last year, and lots of people expected recession last year, and it didn't happen. A lot of it comes from lots of companies and consumer really strengthening their balance sheet during kind of free money period post-COVID, the extra liquidity. So lots of kind of refinancing has happened. And ultimately that again created, so I'm coming back to my kind of two-tier economy, two-tier stock market. Companies with strong balance sheet, asset owners, they're not really feeling the heat of those higher interest rates and tighter financial conditions, but not everyone in this camp. And I think large cap versus small cap, as I said, is the best kind of delineation in terms of equity market performance because smaller companies, their cost of borrowing has increased substantially. Their net interest expense is rising to close to decade high, while larger companies are still okay. So this kind of ability to finance that and refinance that is really, really important for that part of the economy.
Marija, great to get you with us. I'm still waiting for the change in the barbell. Marija Veitmane there at State Street with her Monday morning market calls. Other stories trending on your Bloomberg terminal this Monday morning. Donald Trump pledges to double down on tax cuts. That's if he wins a second term as president. The presumed Republican nominee spoke at a rally on Saturday in New Jersey Shore. Part of his 2017 tax law are set to expire in 2025. He vowed a day-one order targeting offshore wind projects. Tesla is facing further protests at its factory in Germany, where the activists are trying to stop the expansion that would require razing part of the surrounding forest. Police say at least 16 people were arrested on Friday following actions including breaking into the airfield, damaging new Tesla vehicles, and blocking a road by the factory. Microsoft plans to spend $4.3 billion building cloud and AI infrastructure in France. Now, the announcement is part of President Emmanuel Macron's Choose France summit, which aims to attract foreign companies and make France a financial hub for the European Union. Amazon, Pfizer, and Morgan Stanley are among the companies poised to boost their presence in the country. And more efforts to support China's economy. The country will start selling its first batch of ultra-long bonds on Friday. It will issue 1 trillion yuan. That's the equivalent to $138 billion of 30-year bonds. This ends months of speculation over when the bonds will actually be rolled out. Coming up, President Biden gears up to hit China with quadruple tariffs. More on that story. And Bloomberg is live at Choose France Summit in Versailles. This hour, we'll speak to the CEO of Ontario Teachers Pension Plan. Joe Taylor joins me. That is at 10:30 Eastern. An exclusive interview with the Goldman Sachs CEO David Solomon. Then the Bloomberg News editor-in-chief John Micklethwaite sits down for an exclusive conversation with the French President Emmanuel Macron. You can catch that interview at 1 p.m. Eastern. Plus, we have more for you. The Treasury Secretary, Janet Yellen, is at 10 a.m. Eastern. Join us for a feast of interviews and news on Bloomberg, where context matters. In New York, where President Biden is said to be looking to strengthen the U.S.'s stance against Chinese imports, quadrupling tariffs on electric vehicles made in the world's second largest economy. And this as Donald Trump responds. He warns that Chinese companies will try to build those cars in Mexico to avoid the tariffs, saying, quote, "I will put 200% tax on every car that comes in from those plants." And they're not going to do that. For more, let's get to Oliver Cook. He joins me to understand. Look, much has been made of this big banner headline about tariffs, Oliver. But I'm looking at what Terry Haynes wrote over the weekend. Biden's tariffs are noise. However, they do signal high geopolitical risk in the reshaping of the U.S. economy. Contextualize noise for me. Good morning.
That's right. And through that noise, Manis, it's the message that we're trying to perceive, which is, again, it may not be down to these EVs on themselves. So the headline, which we sort of had at the beginning of at the end of last week, kind of scooped, you know, now we have the number. It's quadrupling the tariffs to 102% basically on EVs brought into the United States from China. Now, the reason that is a bit of noise is because the Chinese automakers are not targeting at all the U.S. market. They're really targeting the European market because they had this sort of fear of this sort of thing to happen. So, again, this noise that comes out of it and the sound that we get, the message we get from it, is that Biden is going to be very hard on China going into this election. What I think is interesting is what we do not yet have are the other targeted parts of industries where we're also expecting to have tariffs go into. We're going to get that probably a little bit later in the week, but we're talking about doubling, maybe tripling tariffs on other kinds of goods outside of that. And for the Biden administration, this is really a question of having your cake and eating it, being hard on certain parts of the Chinese exports without being hard on the part that really are key for American growth to continue to go forward into this election year.
Yeah, but to a certain extent, look, this is politics and symbolism. Steel and aluminium tariffs will probably increase, we understand as well. It's no irony lost. You're sitting in Brussels, and Europe has their own issue with China, and that was very apparent with Macron, von der Leyen, and Xi Jinping sitting around a table last week. I want to dig in a little bit more on the U.S. side here in terms of the response from Trump on the Biden initiative. I mean, again, very clearly a week of high politicking.
Yeah, I think for both of these candidates, one obviously sitting president, the other hoping to be that, the winning issue for both of them is being tough on China, right? I think the difference you have a little bit with Biden and Trump is Biden's approach seems to be a little bit more targeted, but, still pretty severe. I mean, Trump has talked about 60% tariffs on all Chinese goods across the board. As you were just mentioning in the intro there about cars that are built in Mexico getting a 200% tariff if they're sort of Chinese cars. I mean, this is also a fundamental point on NAFTA, right? And all of these trade agreements that you've got around the world, is that all going to get sort of blown up going into this because, it's seen as sort of going around this? I mean, you had Xi Jinping here in Europe. He was in France. He was also in Hungary, Manis. Yep. What is going on in Hungary? They've got the huge battery supply chain, battery factory for the Chinese there. BYD is building a factory over there. And again, this is all part of reordering the global trade and manufacturing apparatus.
Okay, Oliver, thank you very much. Tracking the stories from the weekend, Oliver Cook. Over to Russia. President Putin reshuffles his defense and security team overnight as the troops advance in Ukraine's Kharkiv region in a new offensive. Mark Champion has been tracking the story. Mark, good to have you with me. So Vladimir Putin replaces a long-standing friend and defense minister with an economist. This is not exactly exceptional, but it's the moving of the chess pieces. It's one of the biggest reshuffles that we've seen in a number of years. Why now? And what exactly is he doing?
Yeah, well, the answer to why now is, in part, whenever he's begun a new term, Putin has tended to have a big reshuffle of the government. And that is in part just to show that, there is renewal at the top, even as he himself continues in power for now 2.5 decades. So it's partly just business as usual in a sense. But the fact that it was Shoigu, the defense minister, who was moved on, that's clearly about a war that is going better now. So Putin can afford to make these kinds of changes without it being seen as a recognition of failure. And yet the war has gone, objectively badly for Russia compared to what they would have expected, what everybody expected, even if now they have turned it around and are back on the sort of front foot on the offensive with the Ukrainians, outgunned, undermanned, and they are beginning to make some sort of a forward movement again.
Well, certainly as Putin's sworn in for his 5th term, people around the world are going to be keeping a close eye on other moves on the chessboard. I want to pivot to Washington with Secretary Blinken over the weekend, warning that Israel lacks a plan for shielding civilians in a post-war world for the U.S. to trust.
Israel's on the trajectory potentially to inherit an insurgency with many armed Hamas left, or if it leaves, a vacuum filled by chaos, filled by anarchy, and probably refilled by Hamas.
So this is all about the credibility of plans. Secretary Blinken, he had a phone call, didn't he, Mark, with the Israeli defense minister. That was over the weekend. To what extent was there progress? We understand 300,000 people have fled Rafah. That still leaves an estimated 700,000 in Rafah. What progress?
Well, I mean, that is the progress. The U.S. Remains committed to its position that the Israelis should not be going into Rafah until civilians are out of the way. The Israelis remain committed to going in. And so there is a kind of clear blue water between the Biden administration and Prime Minister Netanyahu on this. But the U.S. position is it really, if Israel goes in when there are all these civilians, the Israeli kind of explanation is, look, these are being civilians. It's not our fault. It is Hamas using them as human shields. The U.S. is basically saying, well, move them out the way then, and that has begun. And I think it's going to be interesting to see at what pace the Israelis go in and whether they are persuaded to allow more people out.
Mark, thank you. Mark Champion there, covering the very latest on Antony Blinken's comments on the Hamas-Israel war. Join me. We'll take you through the front pages in just a moment. This is Bloomberg. It's your Monday edition of Bloomberg Brief. I'm Marija Veitmane in New York. So the headline is a trillion yuan worth of stimulus in the form of long-end bonds. How is that translating, by the way? That translates to the commodity market. You're seeing copper get a nice boost. Also, aluminium on the rise, up 0.8%, and crude up 0.4%. So what you have here is a real boost above 10,000 in the copper markets. You are just seeing a reversal of losses in aluminium as well, the lowest level in a month. So this stimulus really sort of manifesting itself potentially in the growth. The credit numbers over the weekend in April shrank to the least since 2017. Bond markets were counting down to CPI. From our global headquarters in New York, I'm Marija Veitmane. Let's set your agenda. Countdown to the US CPI. Will a cooling core embolden the risk-on rally? And Washington's trade battle with Beijing intensifies. President Biden is set to quadruple some tariffs on Chinese goods this week. And choosing France, Microsoft, Amazon and others unveil major investments. French President Emmanuel Macron will join Bloomberg TV for an exclusive interview later today. A very good morning. We're going into a week of high tension over what exactly will the tariffs be. Is it theater rather than actual pressure on the Chinese? Equities start 0.1% higher. I'll take anything at 529. So this is the start of a fourth week of a rally in equities. We just had Marija Veitmane from State Street warning about margins. Anything beyond the Mag 7 is pressure. Will you get a disinflation, a deceleration in the core CPI? The last time we had the CPI over a month ago, we saw bonds ratchet higher by 18 basis points on the day. It was a little bit of a shock and it jolted the market, to say the least. So you're looking at 10-year government bonds up. The number you've got to focus on is plus 0.3%, down from 0.4% on the core. JGBs are treading water. There's an interesting dynamic for the Bank of Japan today as far as this is concerned. They've trimmed the amount of bonds that they're actually buying. So this is about a signal to try and cause 30-year paper at the highest level in decades. Now, you are trying to see the Bank of Japan under pressure from the government to close that yield gap, trying to put a floor in yen. It's having fairly limited impact at the moment. Now, look, I've mentioned the CPI to you. It will come tomorrow, and it's probably going to be the biggest test yet of the rally that started just over a month ago. That was when Powell signaled the central bank would not be hiking rates. Well, the Chicago Fed President Austin Goolsbee discussed his thoughts on inflation. This was Friday.
There isn't, at this time, much evidence, in my view, that inflation is stalling out at 3%. If you take a step back, what's happened is inflation went way up in the United States and in everywhere else in the world.
Stallflation. That's the debate. Our stagflation, maybe even, is a tail risk. Justina Lee joins me now. The question that I'm interested to know is how we're positioned. We've come back by 18 basis points. Yields have come down by 18 basis points in the month of May. How do you think we're positioned going into this release?
I think, yeah, like the drop in yields are reflected in the changes in positioning. I mean, if you look at, the official data on how speculators are positioned in Treasury futures, it does look like they've covered a lot of their shorts. And if you look at the JP Morgan survey of client positioning, they are turning long. And I think, that is reflected in the bond yields in that investors collectively seem to have breathed a sigh of relief after kind of the Fed indicated that they were at least not thinking about tightening. And so I think there really is a lot hanging on the inflation numbers that are going to come out this week.
So, as I said, the estimate is for 0.3%, down from 0.4%. Where does that leave us on a year-on-year basis? And how significant would a drop to 0.3% be?
Yeah, I think these sets of numbers are especially critical, kind of given the contradictory signals that we've been getting from the data lately. I mean, on one hand, we're seeing some signs of the labor market cooling, but on the other, I mean, all the inflationary indicators are still looking pretty hot. I mean, if you look at what kind of my colleague heard from, the chief U.S. economist at Deutsche Bank, he's saying that there's a bit of a dovish bias potentially in the reaction to the CPI numbers, in that he thinks investors will be happy to see any signs of progress on inflation. And if we get a sign of that, that could be a cue to buy more treasuries.
Okay, Justina, thank you very much. Yeah, the flamethrower, which is CPI. Let's see what it does to the bond market. Turning our attention over to tech this Monday morning. Apple has closed in on a deal, we understand, with OpenAI. This would be to use ChatGPT on your iPhone to help bring more AI features to your devices. Alex Webb is with me. So this is the big expectation in terms of AI on my next round of iPhone. How would that fit in?
Well, the way it fits into the iPhone is different from how it fits into the broader market as a whole. For Apple, it really is a big competitive threat because, of course, Android is the operating system with which the iPhone and iOS competes most intensely. That is developed by Google. Google has got a very sophisticated AI offering. So if people are going to continue buying iPhones, it needs to be able to compete with Google on that front. How this deal with ChatGPT looks, what exactly it entails, whether it's hardwired into Siri, for instance, we'll find that out presumably at WWDC in a few weeks' time. That's Apple's big developer conference. The one thing, though, you've got to remember is there have been a few AI devices that we've seen released. The reception for them, the reviews of them have been lukewarm, to say that at the very best. And everybody's saying, a lot of the reviews have said, well, what is this phone doing that I can't already do with a smartphone? So Apple does have that huge advantage.
Yeah, I think my favorite line in the story is, it's the biggest upgrade to Siri's 13-year history. So let's see what happens there. Can we talk about SoftBank? Because, again, more plans, more aggressive in AI is the narrative that's coming out. This is after reporting a second quarter profit and a surge in the value of assets, including ARM. What did you walk away with from SoftBank's release?
The thing I found really interesting, actually, were the comments from the CFO about their capacity, sort of implied capacity for more deal making. That their loan-to-value ratio is actually a lot lower than their targets. I think it's about 8%, and they target a maximum of 25%. That gives them a lot of headroom to be more adventurous and take bigger risks. And they seem to be suggesting that they are going to do that. Now, the focus of any deal making they have suggested is going to be in that semiconductor and AI space. We've heard reported that they, not least by Bloomberg, that they are planning, seeking funding for a $100 billion chip venture to compete with NVIDIA. They've also, we understand, they're in talks to acquire GraphCore. That's a British startup developing chips in this AI space that seems to have missed a march when it comes to the competition. So there's lots they could be doing here, and it seems like they have the appetite to do it.
Okay, Alex, thank you very much. Great take there, Alex Webb, on the latest tech stories. Coming up, we are live at the Choose France Summit in Versailles with the CEO of Ontario Teachers Pension Plan, Joe Taylor. Looks after a few dollars. Context matters on Bloomberg. Good morning. It's Bloomberg Brief. I'm Marija in New York. A very good morning. Well, the French President Emmanuel Macron is hosting his annual Choose France event today. That's in Versailles. The event aims to encourage international investment across France. My next guest is there. He is amongst the executives in attendance. Joe Taylor, CEO of Ontario Teachers Pension Plan, joins us for an exclusive conversation. Joe, thank you so much for being with us. You have probably one of the tougher jobs in the world, planning for the future, planning in part for other people's retirements. We debate inflation on a daily basis, but I want to understand what kind of a world you're preparing for. A higher steady state of inflation, a disinflationary world. What regime are you preparing for at OTTP? Good morning.
Well, good morning, and thank you for having me on the show. Well, let me start with inflation. It's very relevant to a plan like ours because we link all of our benefits to inflation. So the higher inflation, the more challenging our liabilities become. I think the other thing we would say is we're operating in a pretty uncertain world. I certainly subscribe to the theory that all of the things that have got us to where we are over the last 10, 15 years as an investment firm may not pan out as well in the next 5 to 10 years. And actually predicting what's happening in the macroeconomy as well as the geopolitical environment is really challenging. So what that brings you back to is actually trying to make good choices on a micro level around the companies that you're looking at and actually assessing whether they're really market leaders in their own domestic country as much as effective internationally. So when you come to France for Ontario Teachers, we have a number of companies here. They're all market leaders in their field. And France is an important market, which is why I'm here today.
And how much more? I mean, I look at the performance that you've had, and it's been tough. You've been underexposed to quoted equities. Real estate has been a tough time for you. But do you need a serious introspection on where you allocate capital to at the moment?
Well, we are the sort of plan where we try to compose a portfolio that is actually not necessarily going to shoot the lights out in really good times, but won't make a catastrophic loss in bad times. And I guess our outlook for 2023 was on the more conservative side, and that's why, back to your point, we missed out a little bit on some of the AI stocks, particularly in the S&P 500. But having said all of that, we have a portfolio which we think is actually quite well placed for what we expect to see through 2024 and 2025. The other thing that Ontario Teachers has is a very high allocation to private businesses, so whether that be in private equity, infrastructure, as well as sort of venture growth. And with those businesses, you really have to make the most of what you have, which is trying to make sure we add value to those businesses and help them grow beyond their local capability as much as possible.
And are we going to see you be a seller of assets in this private equity world? I mean, there's a blockage, isn't there? That's what everybody's telling Danny and I when they come on. It's tough to get assets to market. Are you going to be a seller, a driver of seller of assets this year in the private markets, or looking to do more deals and take more private assets on board?
Well, look, like many investors, we're always very keen to invest when we can get the right entry price. I think, honestly, there's a bit of a mismatch between owners of assets and their price aspirations just at the moment. From our perspective, in terms of the portfolio we own, I mean, clearly we'll sell assets if we get a good price for them, but generally we're a long-term investor. We invest our own capital, which also allows us to do that. And many of our companies are growing at good rates of return, so we'll actually hold those through the cycle to make sure they can deliver their full potential.
Well, let me be slightly more precise. I mean, we're talking about some of the assets that have built up quite nicely. I'm looking at Amica Senior, and there's a great deal of debate as to whether you really are on the point of pulling the gun on selling that. Are you? Is that the intention, and do you think that you can do that this year?
Well, Amica is a great business, and if we get the right price, we'd sell it as we would any asset. I think the issue for us is the future rate of growth you can continue to drive from that sort of business. So it's very well placed in terms of providing great care and retirement security for elderly entrants. But at the same time, there's a development issue in terms of the real estate portfolio in that business, where it's really down to can you get the right sites at the right prices. So, I think we would be looking at it from the perspective of it's a great asset, it's grown very well under our ownership, we've owned it for a long time. I think like anything, we're going to explore whether we continue to make that progress that we have in the last 4 or 5 years.
Now, look, you mentioned that perhaps not having had this sizable exposure to Mag 7 or big AI tech. I'm just curious in terms of the allocation to listed equities, public equities. Do you think that you're at a point of where you will materially scale up, add to those public equities, or are you still hesitant, Joe?
Well, I think the market's pretty fully priced in most countries. If I was picking out a segment we like, it's probably more like medical, which is actually a level below what we're seeing on the technology side, particularly AI stocks. But having said that, we can take equity risk by investing passively in markets as well as taking equity risk across other activities that we do, including private investing. So I don't think we have to do it just as a panacea for actually getting more equity risk into the portfolio. The other question we have is really one of, does it actually add to our liquidity options? So to me, the strongest reason to invest in listed companies at the moment is that you probably have an easier route to liquidity than you do in some of our private businesses.
I mean, I look at the other aspects that have been well reported. And it's to draw the differential rather than labor the point. I mean, you were a trailblazer in terms of property and real estate. I mean, that's down. It's been tougher for you relative to the benchmark. You brought that in-house. And I suppose the question that goes through our mind as journalists and as people that are looking at what you're doing is, are there going to be significant divestments and sales? Are you going to overhaul that property portfolio in any significant way?
Well, we brought the part of the real estate business in-house. We have our own Canadian real estate, Cadillac Fairview, has been hugely successful. But our in-house team is really to try and do two things. So one is invest in other countries, including France, where we have a joint venture with Boreal here. But also to invest in different sectors to what we own at the moment. So our real estate portfolio is quite heavily skewed to office and retail. And over here in Europe, we've been investing in life sciences as well as in industrial real estate opportunities, as well as we've been doing it in Latin America and other parts of the world. So I think that diversification by geography and by sector is really what we're trying to do with our own in-house team, but also to make sure we make similar choices to what we do in our other asset classes in terms of the rates of return and the accuracy of our prediction.
Just listening to what you're saying about, obviously, you're in France, I get that, and the investment narrative for you is about diversification within the property sector. Many people are debating U.S. exceptionalism. It's been a reason to be overweight the U.S., overweight property, overweight equity, etc. Do you think we are hitting some kind of a period, perhaps, where global markets may well challenge that exceptionalism of the U.S.?
I think it's always very dangerous to bet against the US. It's been a very strong market for us and for most investors for 20 years. But if you come back to France, it's currently our 5th largest territory by investment. We've got about 7 billion euros of assets here. We've got some great companies that are market leader in what they do in France. And in terms of your question, in terms of other territories to the US, I mean, Europe's been pretty steadily for us somewhere between 50 and 20% of our portfolio. It has, I think, solid growth rates with large companies with experienced management teams. Certainly on the private side, I'd expect it to remain a core part of our portfolio holding.
Joe, enjoy Versailles. Apparently the weather's a little bit better there than it is here in cold and wet New York. So good luck with that. And we look forward to hearing from a number of voices from Versailles later on today. Joe Taylor of the Ontario Teachers Pension Plan. And as I say, we've got a good lineup for you coming from Choose France Summit in Versailles. 10:30 a.m., an exclusive interview with the Goldman Sachs CEO David Solomon, followed by our editor-in-chief. It is John Micklethwaite sitting down for an exclusive conversation with the French President Emmanuel Macron. You can watch that at 1 p.m. Eastern. Context Matters on Bloomberg. It's Bloomberg Brief. I'm Marija Veitmane in New York. Here's a look at what's ahead this week. Today, an exclusive interview with the French President Emmanuel Macron at 1 p.m. Eastern. And the Counter Economic Forum, powered by Bloomberg, starts on Tuesday. Then we have the April CPI report and the retail sales kick in on Wednesday. Later today, Archegos founder Bill Hwang returns to New York to the courtroom. Opening statements will begin in the criminal trial over the epic 2021 collapse of his family office. Bloomberg's Sonali Basak joins me now on what we can expect. Quite a bruising number if you just think back. Credit Suisse, Nomura, and Morgan Stanley on the hook for $10 billion. That's really what this debate is about, responsibility for these losses.
Responsibility for those losses. And remember, part of the issue here was also the allegations around him conflating the stock prices around very household name stocks like Viacom, CBS as well. So the allegations here revolve around racketeering, conspiracy charges, as well as securities fraud and wire fraud offenses, not only against Bill Hwang, but also his former chief financial officer, as well as his former trader and former risk management, both of whom already pled guilty and will be cooperating witnesses in this trial. So today we'll see the opening arguments from both sides. And of course, this will start a multi-week trial that is being really closely watched, not only by the banks themselves that had lost, to your point, billions of dollars, but also by a lot of the investment community here, where, you know, a lot of this, Manis, had happened in the shield of a family office overview here, where the disclosure rules are not the same as a traditional way hedge fund.
Yeah, and therein lies the leverage aspect to it, and in terms of the internal organizations, were they monitoring, were they, you know, did they have the truth on one side, and were they monitoring robustly on the other? Talk to me, you mentioned there that there's two of his colleagues, former top Archegos associates. They've already pleaded guilty, and they're going to stand trial against him?
Exactly.
What do we know about them? Who are they? Talk to me.
So we're talking about Scott Becker and William Tomita, who are here, former, as we said, top executives at Archegos, who are expected to not only testify, but we expect prosecution to also bring forward more than 24 counterparties here, executives from different banks as well. So that's what we can expect out of the defense. When we think about the former Archegos officials as well, one big question is how they might invoke the past. Bill Hwang's history when it came to Tiger Asia, which had also previously faced charges of its own as far as insider trading goes. Remember, Bill Hwang in that instance didn't admit or deny wrongdoing, but had faced a significant settlement. So how much will they bring in the history, as well as really blame the management at Archegos, versus what the defense might try to do, which is really talk about the bank's own lapses.
Yeah.
And as we know, Credit Suisse itself had a large report as far as its own risk management controls. And there are questions about how much of that might be brought up and whether the judge will allow cross-examination here to a significant degree. We know the defense does not want that to be significant here.
Sonali, thank you so much. Sonali Basak will be tracking the court case against Bill Hwang right here on Bloomberg. Micro movers for you. Alphabet drops. This is as the Google search may be hurt if Apple closes in on the deal with OpenAI and uses ChatGPT. You got GameStop up nearly 20% as its monthly gains mimic the meme stock mania of 2021. Microsoft plans to spend $4.3 billion on building cloud and AI infrastructure in France. And of course, that is the main event of the day. Part of Emmanuel Macron's Choose France, which aims to attract foreign companies to France and make it a financial hub for the European destination. And of course, we will have the Macron interview a little bit later on today. Here's state of play on some of the commodities. Of course, as China steps in with $138 billion worth of stimulus and long bonds, it manifests in the commodity complex going bid.